Hi, everyone. Thank you, Colin, for making that introduction. And thanks, everyone, for joining us for this town hall, the second of these events that have been hosted collaboratively between the American Society of Appraisers, the CBV Institute, the Global Association of Certified Valuators and Analysts, the National Association of Certified Valuators and Analysts, and the Royal Institution of Chartered Surveyors. We have assembled an outstanding panel of experts who will be fielding your questions and giving you technical guidance and advice as to COVID's impact to business valuation and appraisal. So thank you, first off, to Johnny White, the CEO of the American Society of Appraisers. He reached out to our organizations earlier this spring, suggesting that we collaborate on this type of event to allow those of you who practice in business valuation or appraisal to raise questions, get some answers, and some technical advice. And we certainly appreciate Johnny making that effort for the organizations to come together and to continue this collaboration. Also, thank you to the panelists for joining us again, although this time we have a newbie from the GACVA. We're going to get right to it. Our panelists include William Johnson, representing the ASA, Stephen Cole, representing the CBV Institute. We have Wolfgang Nist, representing the Global Association of Certified Valuators and Analysts, Laurie Maston, representing the National Association of Certified Valuators and Analysts, Lee Miller, and Simon Rubinson, both representing the Royal Institution of Chartered Surveyors. We're going to start our presentation with a segment presented by Simon, giving an overview of the macroeconomic environment, and then we'll move into Q&A. So I'll turn this portion of the presentation over to you, Simon.
Thank you, Brian, and thank you, everyone listening in. Look, I see myself as probably helping to set the scene today rather than getting down to the nuts and bolts, which I think the other panelists will get much more, get their hands dirty on. And I think I'm sort of operating at a bit of a higher level here. And hopefully what I have to say will be of some interest, and it will set the scene. What I will do is focus a little bit on sort of the macro sort of discussion that's going on at the present time, and then I want to just sort of highlight some of the trends that we're seeing from our surveys of our ICS members around the globe. I will obviously focus specifically on the results that we're getting around the US, but I think it's quite interesting just to get a feel for what people working in the real estate sector are telling us, not just about where things are today, but what their expectations are. So I want to give a bit of a feel around that as well, if that's okay. So let's start with the first slide, which is really a very high level macro slide. And what I'm trying to gauge is what's going on in any economy, and specifically today in the US economy at the current time. And the problem with many of the data releases that we're all familiar with, whether it is non-farm payrolls, retail sales, industrial production, they are all historic by the time they hit the mat. But and normally that isn't the problem, really, is it? If we get the data that's sort of 4 weeks out of date, it doesn't really matter. But in the current environment, which is such a fluid environment around this pandemic, and changing all the time, to be fair, there's a real desire for higher frequency insight. And I'm sure you've seen elsewhere lots of these sort of weekly activity indices. I focused on the one here produced by the investment bank Jefferies. It's as good as any others, probably a bit better because I like Jefferies, so I'll give them a little plug. It is built around a lot of micro indicators. So you can see I've given some examples there. So public transport ridership, traffic congestion, foot traffic, restaurant bookings, which I think in a way, if you can capture a lot of that information, you're getting real live insights. And it may be that you get rogue scores one week. It's certainly conceivable you get a bit of volatility. You can see that green line there about 3 or 4 weeks ago, or perhaps actually a bit earlier, just looking at this, had a dip down and then bounce back. So you're going to get a bit of that, but I think the trend is pretty helpful. And what it's suggesting, perhaps unsurprisingly to many people listening into this, is that after sort of a bit of a bounce, things seem to be losing momentum or flatlining. And you've got some indications as to reasons or what's driving that flatter trend in the activity index. It's suggesting we're operating around 60% of where we would normally expect to be operating. So that's a long way short. What I can say is it's not inconsistent with the activity indices that Jefferies produced for Europe and the UK. It's all sort of in that area. Some economies are a little bit higher, others may be bouncing around the same area. The UK, for example, is actually slightly lower than this. But it demonstrates that perhaps some of that momentum that we saw with some decent monthly indicators coming out of the US over the past few weeks, which really reference earlier months, are unlikely to be sustained when we get the more timely data, whether it's around retail sales, production, or employment for that matter. So there is understandably a lot of concern about what this means for the outlook. And if we look at the next slide, just move on one, it's inevitable that this issue is featuring very heavily in discussions, whether they're taking place in Washington at Congress, or whether we're listening to discussions around the Federal Reserve. You'll all be pretty clear on the guidance that came out of the last Federal Reserve meeting, I'm pretty sure. And this slide here simply compares what the Fed's dot plot looked like, or let's put another way, what they were expecting for Fed funds at the end year back in December, and what they're expecting now going out to the end of 2022. And I think it is pretty stark when you hear central bankers saying we expect interest rates to remain pretty close to zero now for at least the next 2 years. That tells you something about what their expectations are, one, for inflation, but perhaps more importantly, for the underlying economy. And obviously, these views will evolve. But if this is, the median view of those Fed decision makers, it highlights a challenge that they perceive is not going away anytime soon. Now, alongside that, I know that at the moment there's a lot of discussions going on about a potential new fiscal package. You guys may know even more than me if something's happened today, which I haven't caught up on. But there is a lot of concern about a cliff edge of the packages that have been, the stimulus packages that are being put in place. It is interesting that the behavioural impact that underpins what's going on, because a lot of surveys of people who have been furloughed previously, we were getting reasonably constructive views back from those furloughed colleagues. Without being too upbeat, they were sensing that the outlook wasn't quite so bleak for them. But it's interesting that more recent surveys are suggesting that they are more pessimistic about the opportunity to get their jobs back. And I think that is quite important in terms of the behavioural response you see in the marketplace. And that ultimately will be important in driving spending behaviour, savings, and all that goes with that, and have an impact on restaurants and other areas of consumer spending. So it's not surprising against this background, but there are inevitably the usual sort of challenges around getting fiscal packages together, but that is such a big issue. From what I've seen, read it, and you may have your own views. I mean, it sounds like we will be talking about a package ultimately that can be agreed on, which will be worth something like $1.5 trillion which is a fairly substantial sum. We're talking about something here which I think amounts to around 10% of GDP. We're talking about big numbers, being used here to support the economy. And again, this is not, this is really significant, but really important, because I feel without further fiscal support, there is a real risk of a double dip on the economy, and how that plays out over the medium term clearly remains to be seen. Now, if we move on to the next slide, what we're hearing back from real estate professionals suggests a degree of caution, not just about the near term, but actually further out. Now, there are some sectoral biases here, and you would expect that. But this comes from our commercial property monitor, which is just being collated now, and I think it's due for release next Thursday. And what it's telling us is pretty clear, that tenant demand away from the logistics sector is pretty weak. Well, I don't think you needed me to tell you that. That the level of inducements to try and encourage occupation of offices and retail is going up. These are net balance questions, so they're simply capturing those who say it is going up against those who say it's going down, and you take the percentage and you get what remains, and that is a net balance. It's typically a very good lead indicator. I mean, it's used for loads of big US indicators, including the things like the monthly confidence type indicators that are produced, and the purchasing managers reports as well. But what is perhaps most interesting about this is that when we've asked about the 12-month expectations in terms of the occupier market, there's a very clear signal, but there's not much expectation of a recovery in offices or in retail. Now, we specifically ask about rents, and what we're being told is that rents are likely to fall further over the next 12 months. Well, obviously, it takes time for that process to work, so you might say that's not a surprise. But the fact that they've come back so strongly with these readings for offices and retail tells me that there's a degree of pessimism here which extends beyond the end of this year, and that there is real caution about how the economy is going to recover through the course of 2021 and possibly 2022. And it's interesting on the back of this that most macro forecasts are assuming that at the end of 2021, the economy will still be smaller than it was at the beginning of 2020. So you're talking about a really hard-fought, drawn-out recovery. But what I would just add one more point in all of this, I'm not going to give you numbers on this because I think bogus quantification in terms of forecast is not helpful to anyone. I mean, really around all of this, it's about scenarios, because the health uncertainty around what happens on the health front is really, critical in terms of building a narrative around the macroeconomy. But on top of that, the policy responses that follow the developments on the health front are also critical. So I don't think there's any help in giving you a bogus number, but I do think the idea that the economy will still be smaller at the end of next year than it is now is significant. Now, if we do move on to the next slide, we also ask...
Really quick before you continue, Simon, we're going to post our first poll question.
Okay.
And just as a reminder to everyone, there will be 9 poll questions intermittently through the presentation. In order to earn continuing professional education credit, you need to respond to at least 6. So we'll give you a quick prompt throughout the presentation for you to answer those questions. Continue, Simon.
Okay, so yeah, we also ask a question around capital values for real estate. And we do it in 2 ways. We sometimes do the net balance, and I showed that last time, but we also ask to try and gauge percentage changes, which I think, resonate more with a lot of investors and professionals working in the sector. They want to know the numbers. There is a bit more volatility around this, which is one of the reasons I'm sometimes cautious about presenting it. But I thought it was just instructive because there are just two sectors where we're being told over the next 12 months there's going to be a positive reading in terms of capital values. One of them is prime industrial stroke logistics. Again, that comes off the relatively strong rental background in that area, and it won't surprise anyone with the rise of e-commerce. And the other one is data centers, which perhaps also won't surprise anyone. But you can see across the board, these are not my forecasts. These are the forecasts of professionals working across the US and who work in the real estate area. And it's a pretty stark picture in terms of the outlook. And I think it highlights the challenges about getting back to where we were. And also makes us think about what the new normal genuinely might be. Now, if we move on terms of slides, next slide. What I really wanted to do now is just run through some, some additional questions we included in the survey, which I think are interesting in terms of trying to gauge, again, what the outlook for real estate is. So one of the questions we asked was about how the office footprint might be scaled back over the course of the next 2 years. We're all aware of the rise of e-commerce, but I think the idea of agile working on the scale that is currently being envisaged is something that is a bit new to us all. Perhaps 3 months ago, the death of the office was being rather dramatically being discussed, and I think that was always perhaps a little sensational, but there's no doubt in terms of the feedback and the commentary that we're getting back from a lot of people who work in the sector that the office environment is going to look very different in the future. And this is a structural change rather than a cyclical change. And I think, when it comes to retail, we're certainly getting both of those, cyclical and structural. I would say probably with offices, we're getting a bit of both. The structural may not be as dramatic as it is in terms of the e-commerce impact, but what we're being told here is that a fairly significant proportion of respondents, something like 2/3, do expect the office footprint to be squeezed back by about 10% or up to 10% over the next 2 years alone. So we're thinking about a relatively short time horizon in terms of the way that people think about their estate. And you can see that, there's a proportion, something like a 30%, who think it will be greater. Now, the purple blocks are the US. You can see I've also put a global figure in there from our survey. That is slightly lower in the up to 10% range, and overall it's slightly lower as well. But nevertheless, you can see this does seem to be part of a global trend. If we can now move on to my penultimate slide, this is again very much focused on the office issue and where offices are likely to be located. So, one of the things that's, certainly if you live in a big city, at the moment there's this whole discussion about how one uses public transport. And I think that is something that isn't going to go away. We're being told very strongly that there is an appetite on the part of property professionals and indeed the sector to think about the rise of suburban offices in place of urban. And that might sound, I wonder about the implications of that. Having been someone who probably is a little older than many other people on this call, on this webinar, I remember London, I remember New York as well in the 70s and 80s, and what big cities were like, or the centres of big cities were like. And I do wonder what this means. It's some quite interesting ideas about where people are going to want to locate, where people are going to want to work, and where people are going to want to live. So we're being told quite strongly, and the US results again in purple, almost sort of, I'd say over 90% of respondents are suggesting that there is going to be a shift away from those highly urbanized centres to the suburban locations. And then my final slide, I just wanted to play out one other theme, and that is, it's quite clear that people want better, in the light of COVID, people are going to want better health and well-being facilities. And in fact, we asked a question, and pretty much 95% of respondents say that this is going to be the expectation. But it's interesting, when we ask who was going to pay for it, it becomes obviously, and perhaps not surprisingly, more challenging. And in the US, interestingly, perhaps a higher proportion see tenants as being willing to pay more for better health and well-being facilities than elsewhere. But this could reflect that the comparator is the globe, and that includes a lot of emerging economies where I think the answer might be very different. So it probably isn't an entirely fair comparison. So let me just wrap up what I've said and what I'm about to say today. I want to focus primarily on the economy, and I see it as I would always like to be more optimistic and have a half full glass than a half empty one, but I think it's very difficult in the current environment not to be concerned about a double dip. I think the policy response is demonstratively agile and substantial, and will help for the time being, providing we get this next fiscal stimulus, to alleviate that double dip. But obviously, given the uncertainties around how COVID plays out, both in the US and globally, it's impossible to make a definitive call on that. And it may well be the case that more interventions, more quantitative easing, more fiscal stimulus will be required over the coming months. What's clear from the responses we're getting from RICS members, both in the US and around the world, actually, for that matter, is there's a huge degree of caution about the outlook, and that caution extends through the course of next year. There's very little optimism about an uplift in rents or capital values. And normally, I think, when we talk to a lot of our members, they are often, you would expect property people to have an optimism bias. That clearly isn't visible in the responses we're getting at the moment. So I'm going to finish off there, and I'll hand you back to Brian.
We'll launch another poll question, please, Colin. And a question did come in for you, Simon. What about multifamily apartments?
Yeah, well, look, multifamily is one that I actually thought the results would be more resilient, actually, but it's interesting that what we've seen is that, the numbers, I think that, there is going to be, a strong layer of demand there, but what we're seeing is some pressure on capital values, even in that segment of the market. So I'd expected to see that as a more resilient area. But the feedback that we've got from people working in the sector seem to be a little bit cautious about that, and it might be simply a function of the fact that if the macro economy is weak, that has a direct impact on people's ability to pay. And I suppose that I think it's the uncertainty around the economy which is capturing that. And I have to say, interestingly, when I've looked at other economies and other markets, we've got a fairly similar picture. I've expected it to be, I would have expected multifamily perhaps to be a bit more resilient in terms of numbers. But as you can see from the capital value chart that we had, it was a negative reading, although not dramatically negative, but it was negative.
And one last question or comment, that the trend in aged care facilities is surprising. Any comment about that?
Well, again, these, I'm just looking at these results. We only just got them in earlier this week. And I suspect that longer term, the aged care facilities probably is a decent asset class to be focused on. But I think perhaps in the near term, there are concerns about how COVID plays out and how it plays out in many different areas of the economy. Perhaps that's driving the responses that we got, but we did get, as you can see, fairly cautious responses about the sector.
Great. Well, thank you very much for that, Simon. And we look forward to you participating in our Q&A a little bit later with the other panelists. We're now going to make a quick introduction of the other panelists who are with us, and we're going to start with Stephen. Hi, Stephen. How are you doing? And you're muted. We'll just give Steve a second to unmute his mic.
I'm unmuted now. Thank you.
Great. And you had some slides to share, but the question will start with you, Stephen. Maynard Keynes, who was a British economist whose ideas fundamentally changed the theory and practice of macroeconomics and the economic policies of governments, he said the markets can remain irrational longer than you can remain solvent. So if that is true, does that mean fair market value will often be determined in an irrational market? And the second question, is that the same as saying that FMV can be irrational?
Thank you for asking that question. That quote was made in 1930 at the outset of the Great Depression. Ben Graham, whom everyone knows, the author of The Intelligent Investor, said similarly 20 years later, he spoke about Mr. Market and the irrationality of Mr. Market. I think the essence of the quote is to say that markets can be irrational for prolonged periods of time, particularly the public markets. And so I think the answer is that fair market value will have to be determined in very skewed markets. I don't think that the word fair means that the valuator can arbitrarily neutralize aberrant markets. So you could have meaningfully depressed values or irrationally exuberant values in very aberrant markets. I think the second import of the question is that even where you know value is fundamentally sound, the markets are depressed. For example, so much of the Frank Russell is underwater today. I don't think it's the valuator's role to lift value to what they think is a more normalized level, or to reduce it where in a tech sector it's aberrantly high. So those would be my comments about that quote. I think the variability or the volatility is less clear in the private markets, and the private market multiples and discount rates and equity risk premiums are more stable than the public markets.
Sorry, go ahead.
No, go ahead.
No, I was going to ask that you provided a few slides for this presentation. Is this the one you would like us to show, or do you want us to move to the next?
No, I think the importance of this slide is just to show that one size does not fit all. You can see that pharma and tech have sustained or grown value, and the broad swath of the other industries have lost enormous value. And so using very general multiples or discount rates or equity risk premiums can be seriously wrong today. So my takeaway from this slide is you need to be very specific about the industry and the company before selecting discount rates or equity risk premiums. You cannot generalize in today's market. You can't generalize in the industry or even within the industry. I think the last slide, if you wish to go to that, the next one. If you go to the next slide, could you go to the next slide?
Did it refresh for you, Stephen?
Yes. Yes, now it has. What was fascinating to me was to see that Starbucks' cost of equity was, as you can see, in the range of 5.7% a year ago. And today, if it were not for the change in interest rates, it would be 8%, which is a dramatic rise. And when you look across those other companies, you can see that there are, in many cases, meaningful changes in the cost of equity. And were it not for the moderating effect of falling interest rates, you would have even higher costs of equity. What's also interesting is that in Microsoft's case or Walmart's case, the changes are very, very modest. And to me, what this told me was that there's an exaggerated importance to getting the cash flow projections right. The probability adjusted cash flows when you're doing your discount models are even more important than ever, because I don't think the equity risk premiums are generally capturing all the risk. So it is true you need to be careful not to double count, but I think the more accurate valuations will come from accurate cash flows as opposed to getting the discount rate or the equity cost of equity specifically correct.
Thank you very much, Stephen, for that.
Those are my comments.
Thank you for that commentary. And we also will post some additional questions to you as we continue through the webinar. Now we'll introduce to the audience Bill Johnson. Bill, how does your perspective and approach currently compare to at March 31st, 2020 and pre-COVID?
Yeah, thanks for the question. And so now I know when we did the previous webinar, I'm in the New York City, work in New York City. We were considered the epicenter of the pandemic, and now our tri-state area, we have something like 30 states that have to put themselves in quarantine if they enter our area. So it's just interesting to, from a just general standpoint, note what's changed just in those few months. From a valuation standpoint, we spent a lot of time in the previous webinar looking at ways to make normalization adjustments and ways to, with the challenge of getting data and things like that. And actually something that Stephen was touching on was something that I wanted to mention, and that is what I found is that well, first of all, compared to the Great Recession, the bounce back in the markets, at least, has been much more rapid than it was then. And we don't need to get into all the factors, but the Fed intervention, the fiscal policy, stabilized the markets, et cetera, and everything. And so what I found, the one difference is that when we were talking in April, it probably is that we're now at the point where there are a fair number of companies that, from at least a valuation standpoint, public companies have recouped most or all of their value. And it really, I think one difference between now and earlier months and now versus the Great Recession is that you have to really, each industry can be radically different from the other in terms of how you could do a much more traditional valuation approach, and then another, the poorer industry that was at the bottom of the slide, if you're in the cruise line, the hotel, airline, et cetera, it really involves a really deep dive and even businesses, just for example, like an asset management company, the companies I've worked with, at least, the outlook's been, guardedly optimistic now, compared to a couple of months ago. I think we all know what the risks are and everything, but I think that the outlook for some of these businesses is not that different now than it was pre-COVID, and then others, you might have to make a determination. There could be a permanent impact. You really have to dig more into what the what the future looks going to be. And one other thing I just wanted to mention is the whole assumption when you're developing your equity cost of capital and what you assume about a long-term risk-free rate and a long-term equity risk premium. I certainly don't have a better crystal ball than anybody else does, but it just seems like there's a greater appetite these days for debt, for stimulus, negative interest rates in certain countries. And I wonder in the long term if we're going to end up having very low risk-free rates, and eventually, if those low risk-free rates will start to dampen equity rates of return. So, and if, our discount rate is a forward-looking estimate. But one that has changed for me as more time goes on and we talk about more and more stimulus packages is possibly there being a very big change in some of these things and how it may affect what we assume in the future.
Great. Thank you, Bill. Wolfgang, the impact of the pandemic on business models and industries have the same visibility and future free cash flows even more difficult and nebulous. What are the key challenges facing business valuations besides the increased uncertainty for you?
Yeah, thank you, Brian. As a business evaluator, I totally agree with Stephen's comment that we do have to focus much more on developing and deriving the future expected value of cash flows. So nobody has a crystal ball, but I would like to mention one or two or three detailed topics which I'm a little bit worried about the last weeks. And the first is the cash conversion cycle and the working capital during the last month and what could happen and might be happening in the next month. So when business models and sales are shrinking, we have a more or less slightly positive cash effect by the shrinking net working capital. But if the sales will recover in the next month or during the next year, and as the recovery is very fast, we will have a very huge cash need in the net working capital, because the cash conversion cycle has very much increased in most of the industries. And this is a topic where I'm a little bit concerned about in the next month or more of some months. The other point is the cost of financial distress. We see in a lot of my daily work in the last month that we try to figure out how we can capture indirect costs of financial distress in our expectation of future cash flows, though, and it's very hard to find objectified number for what can happen when customers lose trust in the business, or the employees lose trust in their own company, and all these uncertainties from a technical point of view, you only can capture in a DCF forecast with scenarios or simulations from a technical point of view, because this is the only tool we have to deal with such huge uncertain information and input variables. And from a cost of capital point of view or a capital market point of view, I'm very concerned about the irrational things what happened in the capital market, and that stock prices, the relationship between stock prices and fundamental industry economic factors is going to be weaker and weaker. And as a business valuator, I'm using a lot of capital market data coming from stock market, and for all my cost of capital and implied market risk premiums, etc. And I I don't have a final solution for me, but I'm worried about this development if stock prices develop in a liquidity-driven way and are not very much related to fundamental data and fundamental developments. And thank you, Brian.
Thank you, Wolfgang. Also a reminder to the audience, if you have a question, please feel free to type it into the Q&A dialog box in your Zoom control panel. You can also type it into the chat. Either way, we'll get to your question. But there are some really good ones coming in. We're going to take a minute or two to get through our panelists. Next up, Laurie, giving us some perspective. Laurie, thinking back over the last 4 months, what types of engagements have you been hired to perform, and have you had any surprises?
Actually, that's a great question. And my response is quite different than if you would have asked me 3 months ago or a month ago. The types of engagements we're seeing are the typical ones that I would expect. Partnership disputes, divorces. Actually, a lot of the divorces are settling, and I think that might be an issue with, in the US, the delivery that might need to be had in the courtrooms itself. I mean, there's just the different judges have different tolerances for having court or being online, and there's security issues there, and different regions within different states have different rules. So I think some of those cases that can settle or are settling, which I think is good. We're still getting hired to help with some of the mediation involved. What I've been surprised with is there's a lot of M&A that I have been requested to, chime in on. And from the standpoint of long-term plans, people in their late 60s, early 70s, getting ready to transitioning over to, key employees. And, it's quite surprising, but, their strategy is, hey, we've been planning on this for a long time. We're going to continue to move forward. We know COVID's here. And so maybe the sentiment is a little bit more positive from them. But I think much like how real estate had a lag when we had, 2008-9 come through, and there's just a backlog of contracts out there for development and building and growth. The real estate, kind of didn't really see a slowdown until like 2010, 2011, and then they had a pickup. And I think maybe our work might be similar. So some of these in the pipeline engagements, I think, are still moving forward from a litigation standpoint. Those that can settle are, they're trying really harder to settle those cases. And one last area that I think has really been surprising is there's been quite a bit more requests for estate planning. And there's been several strategies that have been put forth. One is kind of taking advantage, kind of the one everybody knows, taking advantage of maybe a possible dip in value for COVID-19 and the impact that that's having. Some of them have been, though, that there's fear that Tax Cuts Jobs Act will be repealed. And there's limited ways we're going to pay for the bailout. And one of them is going to be through taxes, potentially. And so there's maybe a fear that whatever we have right now is going to go away. So there's a lot of planning, going on in that area. The other thing we're seeing is some requests on bankruptcies. Of course, their bankruptcies, mortgage loan default rates are things we're always looking at in the economy anyway. But when we think about, small businesses, both Stephen and Lee were talking about this as well. When we look at GDP and growth and closures of businesses, the closure rate has been really high. In 2006 to 2019, this just as an example, for professional technical services, so all of us, the average closure rate, which includes everything, bankruptcies, et cetera, was around 7%. And interestingly, there's the expectation currently under COVID, we are at high risk for closure in our field, which I think is crazy because we're more busy than we have been in the past. But I think that speaks to for the US at least, about 50%, a huge majority of our GDP is driven by small businesses. And as those smaller businesses can't weather the long-term closures or the opening and closing and opening and closing, that's pulling all of that kind of down a little bit. So anyway, those are my observations. I think I want to just chime in on the, I'm just calling it statist versus nationalist viewpoint of industries. You know, we see industries in generalities and you know, these smaller businesses in these local, you know, environments that have hotspots or have different rules. We're all closed, we're not closed. Here in Denver, we just had an announcement that bars have to close, stop serving alcohol starting at 10 o'clock instead of 2 o'clock in the morning, because the governor feels that alcohol is leading to misjudgment and exposure. So there's just some really interesting things that I think no matter what we say, you really have to drill down into those actual facts. I see Lee shaking his head and I'm like, yeah, you have to drill into the actual facts at the location. I do think the size of the business matters, and we have some great questions that I'm looking forward to, Brian, on the PPP and how that's treated. So I'll stop right now. Thank you.
Thank you very much, Laurie, and punting also to Lee. Lee, for you, can the V-shaped recovery in equities be explained relative to longer-term economic recovery? And how should this impact private company valuations?
Thanks, Brian. It's a great question, and I'll admit I wrote it, so hopefully I have an answer for you.
Brilliant mind behind that.
So, you know, clearly I believe there's a bit of a disconnect, and let me just quote some statistics that I wrote down. Back in February, the Dow hit a high of 29,550. As of a few minutes ago, we were at 26,873. I see we're at 26,924 right now. So it's a drop of only 8 to 9% off of our high. And the S&P is actually doing much better. The S&P hit a high of 3386. It's probably trading at about 3270 right now, so about 4% off of its high. And as probably everybody knows, the NASDAQ is trading at new highs. And so clearly there's this disconnect between the stock market, which is anticipating significant recoveries, versus what we've heard from Stephen, from Simon on the economy, which is, and based upon what I see from the economic studies I look at, it's not anticipated that the economy will recover before 2022, 2021, late 2022, to the 2019 levels, and would even be longer to sort of achieve the potential that it would have achieved had COVID not hit. And so you're looking at a 2 to 3 year period before we get back to baseline. And that to me does not seem like a 4, 5, 7% type of a discount off of 2019, early 2020 equity levels. And so there's obviously a lot of good news built in there. And maybe just to emphasize the point about public versus private valuations, I got a question this morning from a good friend that used to work with me. Hopefully he's attending the session today. In essence, the question is, why aren't traditional methodologies working anymore, in particular multiples of historical earnings? And I guess the question about whether our valuation methodologies are broken comes up every 10 years or so. It's coming up now. It came up during the financial crisis. It was going the other way during the internet bubble of the early 2000s. And I'm going to jump on the Wolfgang, Bill, and Stephen bandwagon here of emphasizing how important discounted cash flow methodology is. You know, buyers only pay for future earnings. I don't think that's a controversial statement. Buyers pay for future earnings. It's true for businesses. It's true for real estate. So methodologies like market multiples of EBITDA or revenue based upon historical earnings or trailing earnings are really just a proxy or a rule of thumb of what's expected to happen in the future. And I think it's also non-controversial to say that multiples of EBITDA are really based upon growth of margin assumptions, and multiples of revenue are based upon the actual margin itself and the growth of margin. And so these really do stand in as proxies or rules of thumb for discounted cash flow approach. And so if we have sellers who are prepared to make robust forecasts, who are prepared to make multiple forecasts based upon scenarios, and I'm going to go back to what I said a couple months ago, which is I think now more than ever, scenarios and scenario planning based upon the length of period of time that we're going to be in this crisis is at a real premium, because liquidity, as Wolfgang was saying, is going to be at a real premium. Companies may be able to survive 2 or 3 more months of this, but won't be able to survive 6 or 12. And so multiple scenario planning, expected value calculations, I think are all the more important. And people who are still hoping that their traditional methodologies around market multiples, even forecasted multiples, are really allowing the market to make those judgments for us. In other words, then the market's making the judgment around growth. The market is making the judgment around liquidity and risk. You're also relying heavily on the comps that you're picking to be close enough or similar enough. And so there's a sense that using a market approach may be more simple because you pick good comps and you get an answer. The fact of the matter is that market approach and market multiples have multiple layers of assumptions that are built into those multiples that may or may not be applicable to your subject business. And so certainly market multiples are an important approach, and we should never ignore it, because it is a sense for what analysts and arbitrage are indicating about certain businesses and sectors. But understanding our own business, understanding the company that we're trying to value, building robust forecasts, making our judgments around risk, having a good understanding of discount rate, I think are really the sort of robust kind of analyses that are really most appropriate during challenging times of the kind that we're living through now. And maybe just even referring back to some comments that I made on the last call about financial reporting, I think putting my auditor hat on for the moment are something that we're expecting to see. So the more robust, the more thoughtful the analysis, I think the more credibility it has. And I think, there are now really solid guidelines available in the market around the work that the CEIV BPOs have done. The consortium of BPOs around mandatory performance framework is the level of work product that I think is needed now as much as ever. And Brian, I can stop there.
Thank you, Lee. Now we'll open up the next portion of this webinar to general Q&A from our panelists. We've got some really good questions that have come in. Another reminder to the audience, if you have a question, please put it into the Q&A panel in your Zoom dialog box. And we'll start with this one for those of you who might be able to address it. Is there any data separating economic issues related to COVID-19 and economic issues related to civil unrest? No?
I've never seen any. It's Steve Cole. I think I've seen valuators try and bifurcate COVID effects, but not civil unrest.
I've seen separation on the oil and gas and where that was going in 2019. I've seen people try to peel that out, but I agree with Stephen, I've not seen anything published, and maybe there's something in the works, but I've not seen anything published on the civil unrest. And maybe there's some local analysis that's being done on that.
Mm-hmm.
From a macro perspective, I've not seen anything. I've been looking out for all these sort of different angles on what's going on, and I've not, at the moment, seen anything that breaks it down in that way.
All right, thank you.
I'll just add that to the extent that certain industries or sectors or businesses are becoming more politicized, and the gender or the race issues are just one aspect of potential politicism. I think you have to think about risk and whether or not you lose part of your consumer group because things are politicized.
Mm-hmm. All right, next question. How a evaluator can back up his work around probability-based scenarios in order to forecast cash flows? What could be the best sources of data available right now which could help in developing these scenarios given the uncertainty around lots of economic indicators? Laurie?
Well, I'll start because I know this is me stirring the pot, so to speak. But I think a good starting point is to even just look at the sentiment amongst your peers. I mean, these polling questions that we've had, we have a question, whether we can publish this information after this webinar is over. And I think it's a great idea. But one thing is to look at and see what your peers are thinking. When you're looking at that probability weighted, honestly, Lee and Wolfgang, I agree with you. DCF is the way to go, and it depends on the purpose in the industry, but in general, that's probably the best way to capture things. But even in our DCF, we're going to have some probability issues that we have to come up with, and honestly, I think one that a lot of us aren't talking about is there's a probability that maybe we should be putting some weight on the adjusted net asset method rather than doing a DCF, right? But if one of our poll questions, and I don't remember the exact, but I think there's a little more than 65% of us thought that it's going to take 2 to 3 years for recovery in general for the economy. And if our cost of equity, our risk rate, all of these things that we talk about, that denominator piece, are tied to the economy that we don't think is going to recover for 2 to 3 years, and then parsing into that the industry sector and the location and the size of the business and their ability to withstand things. All of that being said, I would not be surprised to be giving at least 50% weight to having an ice cream scoop in your DCF cash flows that doesn't even come back to what 2019 was until, say, 2023. So I'll stop there because I know that there's a lot out there for you guys to argue with me about.
You have comments?
I don't have any, or I'll go ahead.
I was just going to agree with Laurie. I think that basically for every potential scenario, you'd have a different set of cash flows. And while that puts a great deal of burden on either us as valuation professionals or us asking our clients for more information, I think it goes to maybe the commentary that I was making before, which is it goes to not only the ability for these companies to recover, but for them to withstand and sustain themselves during a lengthy period of recovery. And I think the more scenarios we can develop, the more helpful it is for us as valuators, but also from a planning perspective, as those companies need to work their way through over the next 3 years.
Bill, did you have a comment?
Oh, yeah. I was going to say I agree with what everybody has said so far, but I just wanted to make a couple of quick points. One frustrating thing I occasionally see is either within our firm or outside of our firm, somebody does a scenario analysis and they do plus or minus 10% from the base, and they assume 50% base, 25% downside, 25% upside, and it kind of all balances out to the base case scenario. You're not really, in my opinion, adding any value there by doing something like that. You're just basically creating an equal distribution on each side and coming up with the same value. So there should be a lot more thought put into the more likely probabilities. And I would just quickly say, while it's not completely analogous, I was on the contingent consideration working group, and one thing that was just noted was that usually the values people had been using in the older days based on scenario analyses would give you a higher value than the option analyses would come out with. So you have to be careful about conscious or subconscious bias, that you think there's no chance there's going to be that kind of downturn. and what's really your base case scenario, and versus downside.
It's Steve Cool. I also agree with everyone, but would add that very few small and even large mid-sized businesses have taken the time to do this kind of careful thinking. And the role of an advisor may well be just to be a catalyst to ask the client to rethink the business. Very few medium or large size businesses really have done this kind of careful scenario analysis. And I doubt many of us are capable of doing it in a standalone environment. The client has to be actively engaged for the data to be real. The other thing I would say to Laurie's question about where to get the probabilities, we've often polled industry consultants to get their sense of it, or analyst reports to get their sense of it, or retired executives. I think the only way you get these probabilities is to poll the market. I don't think we can do it from an ivory tower in a professional office.
I would like to add some thoughts. I totally agree with William about what happened in the valuation praxis with the scenarios. I very often see the same, that we have three scenarios with a plus and minus of 10% around the most likely case. But think what happened in the last weeks. If a DCF is based on the most likely cash flow, so this might fit to a normal distribution world, to a major company in a major stable industry, in a major or a very stable economy. What happened now is that the risk factors, the probability of negative things increased a lot. So it is very, very likely that we have a left skewed distribution of further things what can happen in the future. So the expected cash flows must be a little bit smaller, more or less, than the most likely cash flow in a left skewed distribution. And to be honest, as smaller a company is, the most realistic the real worst case scenario might be liquidation. As smaller a company is, this is sometimes the honestly worst case scenario. But I know how difficult it is to defend probabilities, and that's the reason you have to back up these probabilities with market information, as Stephen told, or you have to develop these probabilities together with the client. The probabilities they come not from the sky. So you have to ask the right question. You have to identify fixed costs in the business model, to get a feeling if sales move up and down, how cash flows, how variable are cash flows. And the fixed cost thing is a very, very, very important point of thinking if you think in scenarios or uncertain future cash flow. So fixed cost is one very important thing I would like to add here.
Thank you. Next question is a pretty good one. Can we define what is meant by recovery? Does that mean the GDP is equal to its peak before COVID-19, or just that we are no longer in a recession, or per capita GDP levels? Maybe that's stew on that for a minute, audience or our panelists. And
I think Simon is the best one to answer that because he's the economist. We're all being quiet.
Yeah, so am I. I mean, look, I think that, the nature of what is a recovery is always an open one. You know, the idea of a recession is 2 quarters of negative growth is questionable. You know, 2 quarters of negative growth might be negative to the tune of 0.1 and 0.1. And employment may still be rising in that environment, but technically could be qualified as a recession. I would have thought that the initial marker would be securing a level of activity which takes us back to where we were prior to the crisis. But inevitably, the recovery will begin before that. But that's still a marker. And, you know, as was mentioned earlier, even when we get back to that position, we're still grappling with the lost output if the economy had been continuing to grow on the trend in the absence of the COVID shock. So, you know, you can have a recovery and it may not feel very much like a recovery in many respects. You will start to see growth begin to accumulate quarter on quarter at some point. But against that background, you still may be dealing with higher levels of unemployment than have existed for quite some while. And incomes may still be well below where they were in many cases. So I think it's a good question, but it's not one that I would necessarily say you can definitively answer. And I think it is open to interpretation. That's a great economist answer, really, isn't it? But I don't know if anyone else has any thoughts on it.
I just want to say, from a simple company valuation standpoint, like I look at it more just, when do you think the companies in that industry segment are going to return to the levels of EBITDA or revenue or profitability or cash flow generating ability that they had prior? And if you get too hung up, you got to look at the whole picture. Like maybe the unemployment rate is still higher than it was before, but it's all trending the right way, and the growth gets you back there. So, you know, it's probably a fairly complicated exercise to look at all the different macroeconomic factors.
Yeah, and I think the biggest kind of just general practice concern I have is, I saw this quite a bit in analyses done for 2008, 9, 10, is that some practitioners are mistaking some of this for growth instead of calling it the actual thing, which is just recovery. And, you know, sustainability within the company. So both mistaking recovery in the business trends and the economic trends is something that we're, at least in my shop, certainly going to be more sensitive to. And I think we're going to have to wrap a lot more analysis and language and support, just defensible support around what those decisions are and what we call it. I love, somebody was talking about the synthetic interest rate. We haven't even talked about interest rates yet, but hopefully we'll get into that here in a minute.
Next question. Are any of you using or advocating the use of Monte Carlo simulations around the DCF to consider alternative scenarios regarding the economic recovery or non-recovery? Wolfgang?
Yeah, thank you. I mentioned the simulation earlier. It is a very powerful tool, but it is only a tool. The good thing is that the output is the whole distribution. What after putting all these input factors in the model, you can see you have a good view of everything, of 10,000 of scenarios what could happen. But it is a complex thing. Some input factors are hard to defend. You don't have to defend probabilities, but you sometimes for some distributions you have to defend a standard deviation, or you have to defend why you are using a triangle distribution for that input factor. And so it is a different kind of what you have to defend as a valuator. But again, it is another way to to work with this increasing valuation uncertainty we have in our models, and the improvement to a scenario with 3 scenarios is that if you work with 3 scenarios, you have to defend why exactly these 3 scenarios, and why is your worst case what you think is your worst case. And in a simulation, you have the chance to, for example, you can model illiquidity and liquidation if things happened very bad in this one scenarios of 10,000, the company is dead. It is a powerful tool. We are using these in increasing valuation engagement, but you have to be careful, and you have to dive into a deep learning process if you start with a simulation. So this is not just getting the software and putting numbers in the tool and push the button.
Right.
So be careful with simulation tools.
Any other comments about simulations in Monte Carlo? We'll move on to the next question. What weights would the panel put on the current guideline public transactions method from a valuation perspective as accurate in long term?
While we were talking earlier, I emailed Wolfgang to ask him, would he have the courage, or Lee, or any of us, would we have the courage in our reports to say that we don't believe the public market comps are really comparable, and that we would revert to what we think are the common sense appropriate multiples or discount rates or equity risk premiums? Because in the very volatile markets we have, for all the reasons we've been discussing, they're not reflective. I think, Lee, you were very clear that they're not good proxies. And I think it is incumbent on us in private market valuations, particularly where there are no, or public where there are no special purchasers, to say that these are not comparable and to underweight them. So the answer to the question is I would underweight them on the logic that they're not really comparable.
And I agree, you have to adjust your weightings based upon the confidence that you have in each one of the methodologies. The nice thing about the guideline company or the public multiple method is you have the opportunity to adjust a method. You don't have to take the average. If you find trends in your comp group that are either similar to trends in your company or not similar, you can either strike a comp or you can overweight certain comps for others, and you can make adjustments in the multiple method. And I think that that's just another area of judgment that we need to have the knowledge to apply.
Or you can make size or company specific adjustments
Exactly.
in the equity risk premium and
Exactly.
moderate it that
But
way.
maybe to Wolfgang's point, just taking, picking a comp set and taking the average multiple just doesn't seem, I'm not sure it was ever appropriate, certainly not appropriate in today's times.
Well, and I think you have to be much more careful about what comps you consider to be comparable, because that whole industry-wide SIC approach, I think, is out the window, at least for right now.
From a financial reporting perspective, do you think auditors would accept a wider valuation range, i.e. greater or less than negative 10%?
Am I going to get that one by default?
Can you let us all know what we
You're up, Lee.
I'm going to get that one by default. I'm going to look, there's not going to be a definitive answer to this. It's going to depend on the company. It's going to depend on how able we are to reconcile to an overall market capitalization if we're dealing with a public company. And so I could certainly see certain circumstances. The answer is yeah, we could have a little bit wider range. The question I have is what's the reason for the range? Is the reason for the range we're trying to accomplish obtaining a specific answer, because that's the way it will often seem, or we're just not sure about the value conclusions that we're getting, which is also not a great answer. So I'd like to think that we can still be thoughtful and definitive with our conclusions based upon robust analyses. So I'd like to think the ranges shouldn't be any wider, but I wouldn't eliminate the possibility that it could be considered.
I think when audit committees look at very wide ranges, they want to know what Lee has said, why. But at the end of the day, they've got to come to a number for presentation purposes and for liability purposes. And my experience is that wide ranges are acceptable, but they give audit committees a lot of heartburn, and they are by default required to be on the conservative side, as damaging as that might be. So even if they reveal the wide range, in the end, if they have to land on a number, they're going to have to generally land on the conservative side.
So Stephen, I'll go one more, which is a wider range might be generated by an outlier valuation indication. And my experience has been, if I can't answer the question why it's an outlier, then it's probably not right, or it probably needed to be adjusted, which would have then brought the range in more tightly again.
Yeah, I agree with you, though. Yeah. In recent times, I've been confronted by those wide ranges at audit committee, because certainly in the last 2 quarters, we have no idea of what will demand be in the marketplace. And so some markets are completely constipated and other markets are exuberant. and you just got to make a call.
And to your point, you need to understand what might be generating the variation in results. So the answers to the why, I think, are extremely important, which I completely agree with.
Thank you, gentlemen. Question: how are you adjusting for the non-transferability of PPP loans and PPP loan forgiveness in valuations? Anyone specifically working in that area? Laurie or Bill?
Well, I'll just throw something out there. We haven't had to address that specifically in a transaction, the non-transferability of it. What we are doing is focusing in on whether or not it's likely that the business will meet all the criteria for the debt forgiveness. And interestingly, some businesses seem to be leaning towards maybe not taking advantage of the debt forgiveness, but just taking advantage of low interest rate infusions and have intents on paying it back. And I think either way, you have to have these detailed conversations with management. What are their plans? If they're a larger employer, they have to pre-announce, when they're laying people off. And we're hearing lots of announcements about, this fall, there's a lot of people that are going to be laid off as soon as they meet the deadline that's been set for how long they have to retain the employee. So I think that's a consideration. But Bill, I'll toss it to you.
Well, I'll throw an answer out there, but for full disclosure, I don't normally value those kind of companies with that are getting the PPP. But if non-trans, it's when you're doing evaluation, it's all about what the expected cash flow is of the business. And so most businesses, especially if you're valuing a minority interest, I don't know what particular purpose this is for, but like, for example, you're valuing a minority interest in a business, unless there's like an imminent sale or something like that expected, the minority interest, you'd value it based on what the expected cash flow is going to be. And that would include the PPP. And I wouldn't make an adjustment for it not being transferable, because that's just part of what your expected cash flow is. And you can model in things like Laurie was mentioning with likelihood of forgiveness and everything like that. But I wouldn't, in a scenario like that, I wouldn't make an additional adjustment for non-transferability.
So I'll throw an idea out too, and like Bill, I'll disclaim that I'm not dealing with any companies that have PPP loans, but it seems to me this is not a cash flow issue at all. The loan's already on the books. So to the extent that's forgiven, it moves from liability to equity. And I think it's a non-event from the valuation perspective other than.
Okay. Next, oh, go ahead, Laurie. You're going to make a comment?
Oh, well, I was just going to say, I've seen, a few valuation reports kind of cross my desk in the last couple of weeks. And what I see for small businesses that do have the PPP, there's a statement that it's assumed that the PPP will be forgiven. And the analysts, to me, in a very lazy way, are then just ignoring it. We assume it's going to be forgiven. It was an infusion, so we're not going to incorporate it into our DCF. Boom. It's a wash. So I think that's probably the most dangerous treatment of it, but it's just my opinion.
Stephen gives a thumbs up. Next question. With respect to the guideline public comparables method, would you consider average stock price as opposed to spot price for 3 or 6 month period to normalize the disconnect we are seeing in the public markets at the current time?
No.
Yeah, I wouldn't normally either. And what this kind of gets to, I literally just had a conversation with a company this morning about this, is how do you bridge the gap between what the business was worth before COVID happened and after COVID happened? And it really should be just, the current price is a reflection of what the market thinks at that point in time. The businesses are worth based on growth and profitability and risk and all of those factors. And so you're kind of arbitrarily coming in and saying, well, I think the company's worth more than the market does. Maybe if you're doing an intrinsic value analysis or something, that would like a consulting thing, that would add some value. But I wouldn't for other projects.
So I'll expand on my one-word answer if that's okay, which is by doing an average, there's an inherent assumption of what the future cash flows will be, which will be highly dependent on the type of business. It will be, maybe just getting back to the commentary before, I think this really does stress the need to be thoughtful about what the forecasted cash flows for the subject business are, not the historical cash flows, but the forecasted cash flows. You've got to have a view on that before you can make a decision on anything that you're doing with the multiple approach that would be non-standard.
I agree with Lee. I also think we're damned if we do and damned if we don't. I think that you can't determine the appropriate multiple or discount rate or comp without understanding the quality of the underlying cash flows and the probabilities that have been embedded in those cash flows. And I think a lot of this will be driven by the purpose of the report. If it's an actual M&A transaction, live market, then in a sense, you can be a little more casual because you'll have the opportunity to test the market. If it's a notional marketplace transaction where the number is never going to be tested by the market, then I think it's really, really important to understand how comparable those numbers are. Whether you use spot or average, to me, is not so important as to reconciling to what it's being applied to. What are those rates being applied to?
Mm-hmm. Great. Next question. Regardless of the guideline transactions, doesn't the justification of FMV fall on the company's relationship to its cash flows? Thoughtful on.
Could I repeat the question?
What was that, Lee? Sorry.
I would love to have the question again if you don't mind.
Oh, sure. Regardless of the guideline transactions, doesn't the justification of FMV fall on the company's relationship to its cash flows?
So if I could interpret that a bit, it sounds to me like the question's asking, is fair market value a direct relationship with future cash flows of the company itself? And I hope I'm not over-interpolating. My answer is yes, because I think it's consistent with many of the things we've already talked about. Guideline transactions, again, are just sort of a rule of thumb based upon that the target company's forecasted cash flows and the risk associated with those cash flows that were assumed by the buyer. And so I think I agree with the way the question was phrased. Makes sense to me. I hope I'm interpreting correctly.
I agree with Lee's answer. I interpreted the question the same way.
Okay. Next question. For general small, medium privately held businesses, how does the panel see all of this impacting DLOM?
Well, I'll jump in on that first. So I think when you look at marketability is all about liquidity. I mean, that's the whole thing that drives marketability. And so from a control standpoint versus a non-control standpoint, I think you have to frame it from one versus the other. From a control standpoint, I think you have to look at, well, what's going on in that industry? Are we talking about restaurants that a lot of them are closing? What's the marketability there? I mean, it's going to be how much you can sell all the pots and pans for, potentially, unfortunately, for a lot of restaurants. And so I think you have to still take those standard considerations. Could this business, is it an attractive business? Is it an unattractive business, but one that just is a cash cow? And how are they acting? So I think the same considerations need to be put in there. And I think the question was, are we going to be giving higher discounts for lack of marketability? I'm part of the working group on CSRP right now. And one of the things that we're, trying to address is really to do the job right. And this, Wolfgang, goes back to you a little bit. Beat up the cash flows as much as you possibly can. Leave that subjective nature of the decision out of it. Now, when we look at the cash flows and we look at the marketability of the business, they're tied together in some ways. So to the extent that we've included a lot of these considerations on marketability, on, continuing business, on recurring business, on are we going to be at 60% for the next 2 years, to the extent that there's been a lot of consideration for that already in the cash flows, then I don't know necessarily that you're going to be heaping a bunch more marketability concept on top of that. I think that would be double dipping.
I agree, Laurie. I would just say that in part, the opportunity cost of money and the risk of being a passenger has changed. And so I think that I agree with all that you've said, but would just add that I think over time, both those factors have the volatility in the marketplace exacerbates the risk of being a passenger, and people will demand more return for it. Sure.
Yeah, I think it's a multi-dimensional approach, and I think just correct me if I misunderstand what you're saying, Laurie, but you have to kind of take a step back and see if your overall value and that you're not double counting. But you can, as many people know, quantify a DLOM. One way you can do it is through doing a put option analysis. And if you have a higher volatility and you have a higher holding period, and you start from an aggregate value that's taken into consideration the business risk, all other things being equal, you would have a higher DLOM. It's in a higher volatility period, it's something you can consider.
Yeah, I think you have to be careful how you get your beta and what period it's based on and the faith that you have in that from that perspective as well. So yeah, we can't ignore the denominator, but that last piece, that overlay piece, that discount, I think there's no way to answer that, straight. And I hate to say, the "it depends" phrase, so I'm not going to. But I think it's going to be a lot of professional judgment on how much. I know Mercer is out there saying that he's adding an additional 1% to his discount rate as a COVID factor. So if you were taking up the mantle of Chris Mercer, then how much of that 1% that you're adding to the discount rate is for marketability, for some of those other elements? So I think we're going to have to spend a lot more time on the analyses.
Let me give you an interesting example. Say it was Zoom. Zoom's volatility has probably been a lot higher, but it's because its stock price has been shooting through the roof. That may be a situation where your lack of marketability discount could be lower because of investor interest. So that's just one more example of how it can become complicated.
We had a couple questions relating to PPP loans. So I'll kind of bundle them together for you all to address. One is, can you expand on the treatment of PPP loans for valuation purposes? We have that similar question from different audience members, expanding on the treatment of PPP loans for valuation purposes.
Well, I think I'll start off. You have to have consideration for how much is it, what is it for? Is the business going to benefit from the use of the PPP loan, or is the only benefit going to be to retain the workforce in place and rents? I think there's also consideration and talk about what the second relief funding might be. But I think if you're really thinking clearly about it, not that we're not, but we're all trying to. Is it a deductible item? If you have money coming into the business, yes, I saw a couple of questions and some dialogue that, hey, that increases cash. So maybe that's going to create excess cash. I've seen this in some analyses that I'm reviewing some reports on. So there's a sensitivity to that shouldn't be considered excess cash technically if it's just there to support the payroll for the next period of time. But on the income statement, is it deductible or not? And I think this goes back to BV 101 of when you have a period that's anomalous, that is not recurring, it's not expected to be like this in the future, don't rely on it. And so if we could zoom 3 years in front of us, we'll be taking 2020 and just zero weight on it, right? From a reliability standpoint. So I think some of the complications that we think of with PPP can be set aside depending on how the company's using it, how they're going to be treating it. And ultimately, the big question is, what are our future cash flows forever and always from this business? And forever and always, we're not going to have PPP. So this period of reliance on it is going to have very low weight in the analysis from that standpoint. I think the bigger question is, will the PPP bridge, from a risk standpoint, bridge the business's ability to sustain the short-term, non-recurring and extraordinary event so that it can then, still be a viable business in the future? Bill?
Yeah. Hi. Well, that's. I don't think I have much to add to that. I think that was I think that question really, my personal opinion is, it dovetails well with the previous question in terms of treatment. I think we also, in addition to your response, talked about that. It's like any situation when you have depends what side of the balance sheet you're looking at, but a non-operating asset or non-operating liability, you just assess likelihood of what's going to happen, and is part or all of it related to the operations, like Laurie said, and et cetera. And I would just treat it like you would treat other. Again, depends on what side of the balance sheet you're looking at, but a non-operating item that you'd have to consider how much of it is operating or non-operating.
We've actually got a really good poll question up right now. Should valuers be considering applying an adjusted short-term WACC to the near term and a more normal WACC in the mid to long term? We're seeing the results coming in from the audience But any comments on that?
Could you repeat the question again, please?
Yes. Should valuers be considering applying an adjusted short-term WACC to the near term and a more normal WACC in the mid to long term?
I think that question is asking if we should be using different discount rates to discount cash flows during a DCF and in a single DCF using more than one discount rate. My answer to that would be I generally don't think using multiple discount rates at different periods of time in a DCF is appropriate. Now, sensitizing the DCF for different discount rates to develop a range is appropriate, but that's based upon a range of risks. But using, for instance, 11 or 12% in periods 1 and 2 versus 13 or 15% in the other periods, generally speaking, I would not agree with that approach.
Wolfgang, you had a comment?
Yeah, it might be a little bit different to Lies.
That's the beauty of the discussion, Wolfgang.
Exactly. So my answer, it depends on the standard of value. That's just the most important starting point. But for example, if you are looking for a value for the owner or a value for the buyer, and you have a forecast of the future income and future balance sheet items and future cash flows, and things will change. And what I mean with things is a lot of things can change, and a lot of things have impact on the WACC. For example, if the companies were loaded up with debt now to finance their cash outs, so we have a huge increase in the leverage and the debt now. But if we assume that business models will recover maybe in 2-3 years, and they will generate cash again, free cash flow, and then they have the chance to repay their debt, I hope so, then the leverage will change. And this is exactly what happened in a WACC, that the weightings of the cost of equity and cost of debt will change. The cost of debt can change as well in a forecast, because if the rating of a business model will change in the future, also the cost of debt will change. And more important, the cost of equity, or especially the unlevered cost of equity, the operating risk can also change in the future. So there are a lot of factors from coming from the business model influencing the factors, the input factors for the WACC, who can change in the future. But to be honest, it depends on the standard of value. If you capture this perspective, if you will deal with such a detail, or if you step a little bit out for the cost of capital and give more weightings on peer group leverage, for example, and this is a direction in the fair market value and fair value world. So you don't want to deal exactly with the debt development in your forecast. So, but it depends on the standard of value. And if you're looking for the value for the owner or the investment value from the perspective of a buyer, yes, you can. In my opinion, you can deal with this concrete forecast of, for example, debt. And if debt and leverage will change, WACC will change as well.
Wolfgang, you and I are going to have that conversation over a beer one day.
Exactly, but a German beer.
A German beer.
No.
Next webinar.
Stephen, did you have a comment or?
Brent, I would just add, that from a small, I feel like I'm the voice of the small business valuation people here. So not fair value, not the things that Lee's dealing with, because I understand the need for consistency and the modeling in those. I totally get it. But from a practical standpoint, if we know risk is different now than it will be a year from now or 2 years from now, and we're all saying, hey, do a DCF, and we need 3, maybe years at least, maybe 5, expand, contract like an accordion on your DCF model. I think one way that would be a legitimate way to, it's professional, judgment to account for risk is maybe shorter term, we have a higher risk, and we can't really confidently model that fully into the cash flows. And so maybe in the short term, and I'm not talking about WACC, because then you get into the whole debt issue. But if you're just using a discount rate, based on CAPM, as an example, then maybe the shorter term periods would have a higher risk depending on what you've already done. But don't make sausage out of it. We're putting all these components in, and at the end of the day, we need a real protein, right? An identifiable protein. So the more you play and tinker with your model, the more you're going to have to, defend it. The more you're going to have to, put in additional markers that say, here's what we considered and why, and the basis for it. So I would say that the better part of valor on this is pick one area and really focus in on that. If it's your cash flows, really try to model that in. And then, Lee, there's no need to change that. PPP, how's that going to impact me? That's a smaller company issue. So your debt's going to be changing. It depends on how did you treat the debt on the balance sheet. And Wolfgang, this goes to your point, is how did we treat it already? And then, don't mistreat it in the DCF. So my 2 cents.
At the risk of piling on, I agree with Lee, except to say that I think we also have to triangulate. We should get the right answer by different methods, and the different methods will give us different insights. And so Lee's nodding, and I think that's right, isn't it, Lee, that there's different ways to get to Rome.
Sure.
They all should reconcile.
Which is why we're obligated as professionals to attempt to perform as many evaluation methods as possible, so that we do have that triangulation. It gives us confidence,
right?
Exactly. in our answer. I think that's right.
All right, next question. Given the recent push towards niche mergers during these times that may become even more prevalent in the future as AI will eliminate certain jobs in the future, do you anticipate more joint ventures? And if so, do you think this will lend to an increase in deadlock resolutions down the line?
I see lots of these kinds of partnerships and mergers, and I don't think there'll be any increase. I think the governance documents are acutely aware of the problem, and I don't see any reason that there should be any more deadlocks than there were before.
Okay. Thank you. Next question. Given the discussions related to the quality of forecasts and observed multiple rates of return, it appears that in the short term, there could be significant differences for companies with international operations and their related cash flow. How best to handle this potential variability in economic recovery, cash flow certainty, market data, etc., for a company with multiple business lines internationally?
That's one of those cross-examination questions where you say to the lawyer, listen, can you ask me those 12 questions separately, please?
So how best do you handle potential variability in economic recovery?
And I think the key on that is multiple business lines and from an international perspective. And I think it would be no different than just valuing it without the issue of COVID and the economic disparities between the countries that the business operates in. And you've got to look at upstream, and I think you do need to look a little bit more carefully at upstream and downstream industries, suppliers, depending on what the business operations are that cause it to be international, and if they're, in line with each other or not. But I think just my initial response is you still have to go to each of those individual countries that the business does business in, look at that individual country risk and how they're dealing with COVID and their economic bailout that they might be pushing forth to their populace, and see how that impacts the ultimate product or service being offered.
I'll just add to, I think Laurie probably implied this in her answer, maybe you just said it outright, but I think it bears repeating. Just because a business may be located in, say, China, and the Chinese recovery is well underway, if the company is a supplier to the US or some of these other hotspots, they may still experience a depressed level of activity in line with the customers they're serving. And so you need to look at it not only from where is the business based, where does it reside, but also what customers and where are they in the supply chain.
Agreed. Yeah. Where's the pull and push, right?
Exactly.
What additional steps are any of you taking during your COVID-19 valuation reports to protect yourself from Daubert motion?
I don't do litigation, so I think isn't that a litigation thing?
I wear a mask.
Well, I mean, I think outside of like the disclaimers that our standards require, so if it depends on what's the date of analysis, if you're looking at a damages or a business valuation, are you looking at pre versus post COVID? Is it a standards issue from a known or knowable, or is it a subsequent event? But I think, we all have standards and different standards that we all follow, but in general, they all kind of align together that if there's an event, we need to have some kind of disclaimer of whether we've considered it or not. And in planning for this call, I know that there was some conversation around the qualifications that are put into our valuation reports. And I think the consensus was, to the extent that there's too many qualifications in the reports, the question then becomes, is your work really even reliable? Could we or should we rely on it if you keep saying, well, we don't know about the cash flows, but we're using these anyway. We don't know about the risks, so we're adding a couple points here. The client isn't sophisticated enough to help us, with forecasts, so we're making stuff up. I mean, the more of those disclaimers that are in there, the more caveats that you have in there, the less reliable. And that's no different now than it was a year ago. So I think from a Daubert challenge standpoint, am I using reliable methods? Am I using good inputs? Do I have sufficient relevant data to rely upon? Have I applied these methodologies appropriately? All that stuff is still the same. I think really the only thing is the disclaimer that, hey, there's COVID here, but the judges are having these same panel groups. The National Judicial College is having these same things, and all the judges are talking about this too. It's not like nobody knows about COVID, right? So I don't think that there's any additional thing other than I'm trying to support these decisions I made, and how I get there might be a different path than what we've ever done in the past, but everybody's kind of in the same boat right now.
Well, we're 10 minutes from the hour, and we've covered quite a lot of topics and various questions, and we thank the panelists for lending their advice and guidance. Colin, how are we doing on our poll questions?
Yes, so we are on our final poll question right now. It is up.
All right. We'll now turn the time over, and thank you, panelists, for joining us and sharing your thoughts, your expertise. We'll now turn the time over to the executive team from the organizations who organized this town hall. Mary Jane Andrews with the CBV Institute, Johnny White with the American Society of Appraisers, and Neil Shaw with the Royal Institution of Chartered Surveyors. Thank you for working so diligently with your experts and behind the scenes to pull this together, as well as the town hall we hosted in April. From an association perspective, what are some of the things you all are doing to support your members and the profession at large, And we'll start with you, Mary Jane.
Thank you, Brian, and greetings from Canada. I must say it's an honor to work with my VPO colleagues and for CBV Institute to participate in this second town hall. This panel of leading experts has certainly offered interesting, insightful, and brilliant commentary on the current business valuation environment, so thank you so much for that. And I think in chatting with Brian and Neil and Johnny, we all agree these times are unparalleled, and this pandemic has propelled forces of change at a rate that we've never seen before. So it's caused us to really have to pivot quickly to new challenges and to find innovative and creative ways of doing things differently. So at CBV Institute, we now have all of our education and our accreditation process completely online. We hosted a virtual ceremony, awards ceremony, to celebrate our academic achievers and our FCBV and Life member honorees, which we were able to live stream on a YouTube channel so friends and family could participate in real time. Next week, our young professionals in valuation will be hosting a Canadian virtual chat on the impact of COVID to valuation. But I think more importantly, it's also a time to support our entire business valuation community. We have provided free access to our pre-2020 technical webinars. We've provided mental health and wellness resources and practical tools to work from home during these times. But most importantly, from our perspective, is collaboration with other VPOs. I think as we confront challenges to this field, we consider the greater worldview, and that's why this event in particular is so important to the future of our profession, because collaboration has really opened up new possibilities and resources. For example, we have a new international valuation glossary for business valuation, which was a project worked on by a number of VPOs. They'll be going out to the market for broader consultation soon. I honestly believe that we have the brightest minds and collective strength to help tackle some very tough issues when we all work together. And then working together is really going to help us stay focused on the light at the end of this tunnel and keep an eye on the future of our profession for its further success. So thank you everyone for participating in this panel and for allowing me to provide a few remarks.
Thank you, Mary Jane. Johnny?
So thank you very much, Brian, and I want to thank all of the panelists for coming back together. Mary Jane, Neil, and Brian heard me say this statement when I sent the second email. I said, let's bring the band back together. And the reason why I said that is because it was time. As we're seeing in the market, things have changed since the last time we were together. So it was a great opportunity that we were able to come back together. And similar to Mary Jane, here at ASA, we are looking to collaborate more and more, because as my feeling is, the way that we're going to get through this is by becoming together and being partners. And this is an example of being a partner. And then in addition to that, we've been doing a number of things, such as doing a lot of virtual programs. I think all of us have done the same thing. We're not doing any in-person meetings. So for us, it's been virtual, and we're doing a lot of virtual programs each month. Our annual conference is in the fall. We were fortunate enough to be in the spring, or prior to the spring, where we could have had something. So we've transitioned that over to a virtual conference that'll happen in October. We're trying to do something that's very, very different, very innovative. For those that are interested in the conference, we're using avatars just to give you, a sneak peek on something different that I don't think a number of us have done so far. So definitely look out for that information, because that's going to be out of this world in terms of a virtual conference. But we're going to continue to do what we're doing today, and that is working together, because again, as I stated earlier, for us to get through this, we have to work together because it's going to make it better for the profession. So thank you, Brian.
What are the dates of your conference, Johnny?
It is October 11th and 12th.
All right, everyone can go to the ASA website and learn about that conference. Neil?
Thank you, Brian, and thank you for moderating. I could say ditto to Mary Jane and Johnny, but I won't do that. First of all, I want to thank the panelists, Stephen, Lee, Laurie, Bill, Wolfgang, for your generous time and lending your expertise. We know you have day jobs, so we really appreciate it. And Simon Rubinson, our chief economist, whose day job is to be the chief economist of RICS. So thank you very much for sharing your insights and your thought leadership. The partnership with you, Brian, and Johnny and Mary Jane, I think from a VPO perspective, you know, RICS is unusual in this regard. We're a professional body for land, property, construction, and valuation of all asset classes. So this is an important play for us to really partner with you guys. And we'll do it again. You know, we'll keep bringing the band back together, Johnny, as often as you'd like. You know, as a global professional body, we've gone through some challenges. We've gone through some swings in China. We're going through it in the Western Hemisphere now, and throughout all of this, we've had three goals. One is to focus on the well-being of our staff. We've got staff in 26 different countries. Support the profession, you know, with panels and thought leadership plays like this. And then lastly, not waste an opportunity, you know, that this crisis represents to really transform and do some real positive things for the profession. And, you know, some of the work that we've done with this group of VPOs and others has really been to try to collaborate and drive change for the profession, and we're going to continue to do that. So whether it's doing things innovatively like digital conferences, avatars, but ultimately our ethos here is to drive things further, faster through collaboration, and we welcome that opportunity. So thank you, and you know, I wish everybody well through this unprecedented time, and you know, light at the end of the tunnel, Mary Jane. That's exactly what we're hoping for. So thank you.
Absolutely.
Thank you. On behalf of the NACVA and our global association, very similarly, we've produced a lot of continuing education, but very specifically to areas where our members are seeking to grow their practice or getting increased engagements, particularly to the area of bankruptcy, insolvency, and restructuring. We've developed a 15-hour continuing education course that's available through a live webinar series as well as on demand. Business interruptions, lost profits is also a high trending area for our members in their practice. And also, as we spoke a little bit about during this town hall, issues for valuations relating to the PPP loans and other government programs. Additionally, understanding that there could be hardship for our membership, we have offered some extended member benefits, understanding that a professional association like ASA, RICS, and the CBV Institute, it's more than just having a credential and more than having training. It's other resources and how to grow and build your practice in this crazy environment, pivoting from traditional valuation services to other related types of services. And so we've put a lot of effort in providing some guidance and education to those areas, certainly moving towards an online virtual training and taking advantage of these great opportunities to collaborate with these partners, organizations to bring greater knowledge and support to the profession. So it's been challenging times, and certainly we're not through it yet. And so we will conclude today's webinar by again thanking Johnny for the brain trust idea to start this collaboration, and to all the panelists who supported it this time around and in April. And for those of you who joined us, thank you. About 7 to 14 days after the webinar, you will be able to receive your continuing professional education certificate. For those of you who registered through the Zoom platform and not through the NACVA website, we'll be reaching out to you to make sure you are wanting to receive your certificate for educational certificate, and making sure you get all of that squared away so you can log in and get your certificates in the next few weeks. So thanks to everyone for joining us. Thank you, Colin, for being our host. And you'll certainly hear from our organizations in the coming weeks with the next round of opportunity for knowledge sharing and collaboration through our organizations. Stay safe, be healthy, enjoy the rest of the summer, everyone.